I'm Guy Varble, and my wife Nikki Varble, and I own Momentum Wealth Fund. We are, I've been married 26 years, and our kids are 18, 19, and 21. And we started investing in real estate in 2010, and then bought some rental properties, single family, double family, duplex, threeplex, that kind of stuff, and had a 7 unit. In 2018, we got into self-storage. And when we really understood the value of self-storage, that's when we went ahead and decided to sell off our residential rental portfolio. And last year we were able to sell off our very last rental portfolio. And one of the reasons that we like that is in the self-storage arena, there's no landlord-tenant laws. So you don't have to deal with the eviction process. In Iowa, it's called FED, and forcible entry detainer and those types of things. You just don't have to do that. In self-storage, if people don't pay us, we put a lock on their door. If they don't pay us again, then we sell the stuff behind the door that there's a lock on. It's pretty low pressure, low maintenance, and pretty straightforward process. The thing that Nikki and I have decided that we really, really like out of all the things about self-storage is the fact that it's a recession-resistant asset class, meaning that if the things go really bad in the country and people start losing money and losing their houses, and they start getting evicted and foreclosed on, we don't celebrate that. We just recognize in the self-storage industry, the asset class itself, that people find a demand for self-storage when they're having to resize their life and lifestyle. So that's a thing for us that we understand. It's got a recession-resistant aspect to it. When things are going really well and people are making a lot of money, there's a lot of transactions that are happening. People are selling houses, buying houses, rehabbing houses. People are buying more things from businesses, and people are buying more toys. And so they have a demand for self-storage as well. So it's those two things that happen in hand. One thing that we don't really talk about in this presentation is that we like to be near a lot of multifamily. Rental properties are an important part of our decision-making process, but rental properties, specifically multifamily, where they don't have basements and they don't have garages and sheds and that kind of stuff, that becomes a really strong component to our overall value. That's what we like about self-storage. So what we say is this is the world of self-storage, and we would invite you to participate in it with us.
We have seen a steady demand of self-storage over the last 20, 30, 40 years. Back in the 80s, it was less than 3%. And as an average now, we're over 11% as US households. And this is just another graph that talks about, it shows the self-storage growing over the next 5 years. And there really talks about how one of the major factors has to do with an increase in urbanization as one of those driving factors.
One of the, before we get into goals and objectives, I guess one of the things I forgot to mention to the group is if you've got questions, there's a little Q&A button at the bottom. Just go ahead and click on that and type in your question, and we'll keep an eye on the questions as they come through. And if it's going to be answered later, we'll just let it get answered later. Otherwise, towards the end, we'll probably try and answer those questions as they come through. The other part is, as people are coming in later, this will be recorded, and we will give you access to the recording of the presentation, so you'll be able to review it at your own pace. And we're not going to read the slides. We aren't going to go, oh look, goals and objectives, we invest and create. We aren't going to do that, right? So we're just giving you the option to hear us talk about what it is that we like about self-storage and what our passion is, and what we like about this deal specifically. And you can go through and read the slide deck on your own in your own time frame. But one of the goals and objectives that we talk about are kind of be broken down into two main categories. One is we're either going to buy or we're going to build a facility. So it's either going to be a purchase or an acquisition or a development. We have done a conversion of a Sears building. So there's an adaptive reuse aspect that we can look into if the deal makes sense as well. And then the other aspect is we want to increase the overall cash flow, net operating income. We want to increase that over time from the existing facility. And we're going to buy a facility typically that maybe is mismanaged or undermanaged, and or buy or build in an area where we're going to go ahead and build a facility, and that facility is in an undersupplied market. That's what we're going to do. We wouldn't make any sense to go build a facility in an oversupplied market or saturated market. We just don't do that. That's not what we do. And as Nikki later on talks a little bit about how we make decisions, we'll get into that a little bit as well.
So this is our team. This is our team that we work with every day, every week. And we also work with third-party managers. We work with CPAs. We work with attorneys and general contractors and project managers and so on. And what we do, we acquire existing facilities and we develop ground up facilities. And like I mentioned before, we would do big box stores as well. Who we are. So Guy and I, we've been married for 26 years. And in that time, we've learned a lot about ourselves. And we have learned that we both have to have a certain amount of data points to be willing to make a decision. And that we feel that is something that's pretty unique to the two of us. And we have also decided in our time investing in real estate since 2010 that we really enjoy this specific niche of self-storage, and we have decided to only focus on this niche of or class of self-storage. And in doing that, we want to be deeply connected to facility owners, brokers, wholesalers, and other investors that are in the country. This is a small industry in that sense where a lot of people know each other. A lot of people are connected that way, and we just want to grow who we are in this industry.
We talk about a conservative approach. And so there's a conservative approach towards the creation of the capital stack, the debt, the equity, if we do pref or bridge or mezzanine or that kind of stuff. And so we try to be, we like to have as little debt as possible, which is sort of inverted from a lot of people. But when there's more equity and less debt, that makes the deal more secure for everybody who's in there as an equity holder. So in order, though, to give the types of returns that we want to give, we find that we have to be in that 70% debt to value, debt to cost ratio. The other aspect of a conservative approach is, and I sort of jokingly tell the team, don't fall in love with your spreadsheet. Right? Just don't do that, because the spreadsheet, it lies, right? It's not reality. It's not truth. And so the four main expenses in self-storage, right, are property taxes, labor, insurance, and utilities if there's a lot of climate control, temperature control type of property units. In this deal, and specifically all deals, we have our attorneys go out and do an estimate of what the cost of the property taxes will be. And typically we use the higher range of the property tax range that they give us, simply because we want to be conservative in the overall total costs and expenses. And if the property taxes come in below than what we have in the model, then everybody in the deal makes more money. Where if we use the low number to make the deal look better and it came in higher, that wouldn't benefit anybody. It doesn't benefit us, doesn't benefit the investors. So we just try to take a measured and conservative approach towards all of the projects we look at. One of the things that we don't really talk about a lot in this presentation is We underwrite about 15 deals a week all over the country. So we pass on a lot of deals. So when we're talking about a deal, it's a deal that we've really vetted, we really like, and it makes sense to us from all of the underlying criteria.
So who uses self-storage? There are three main types of customers that we believe use our facilities. And one is a business person that will use it for inventory, for like storing their files or storing their tools, if it's a landscaper or a tradesperson, that sort of thing, or someone who is in transition, right? If you're in the process of moving, so you need to store your furniture and whatnot for a period of time, or if you're a student, you need it stored for the summer, right? That's in transition, or there's that emotionally attached person or sentimental type of person. So it's the three main categories that we think of when we think of someone who needs to use a self-storage facility.
Why self-storage? Why now? Why this deal? Like all of those things are great questions. And since we've done a lot of flipping and we had a lot of smaller single family homes and duplexes and stuff like that, we've done rental properties as well. And we understand like those aspects and those asset classes as well. So the thing that I like about self-storage is I see it as a lower risk asset class compared to, let's say, multifamily or even single family rentals. I like single family rentals in that they're slightly more liquid than multifamily, but multifamily also has its own issues. Clearly, excuse me, I see this as a lot more lower risk than maybe office right now, or maybe like during COVID, like all of the shopping malls were pretty risky. A lower risk asset class might be a triple net building with a tier one client, right? Like if you owned a building and you had a 50-year lease with the U.S. Post Office, I'd say that's probably a, a, a a lower risk asset class. I don't think you could get the returns that we offer, but in general, I think it's important that, like for us, we like this asset class. We like how to mitigate that risk in the process.
You've
We
got,
Go ahead.
I'm sorry. We've got a question that came up that fits into this slide real well. The question is, this particular investment, the current units that are in this deal, what is the most appealing? Is the location near multifamily, little saturation, et cetera, or are these properties mismanaged or undermanaged?
Right, and so I think you're right. So the things that we like about these facilities themselves is one, there's a large number of them, so that's good. In the Boone area, we're going to have a majority of the market share, which means we get to control. Like, and we don't get to like manipulate and all that kind of stuff, but we get to set rates. We don't want to be the low price leader ever. Right? That's not how we do that. We don't manage that way. So we get to control in the Boone area. That's good. In the Ames area, it's not as close to ISU, but it is definitely in a college town. That's an important component when we look at the cyclicality of when units get rented and rented in and out. So that's a portion of it. The one in Granger's right on the 141. It's got a massive amount of traffic to it. So that's an important aspect to it. Even though the amount of population that lives in that area might be lower than we would normally want for a specific area, it's got a massive amount of traffic, which is really, really good. The one in Madrid is good. The ones in Huxley are newer. They've got they've got some climate control. They've got gates and those types of stuff. And so this portfolio has Class A, Class B, and Class C properties in it, right? It also has a lot of I would say opportunity to actually manage it professionally. Okay, so I would say that the previous owner was under managing it. Every time that we called, I think I only ever got them to answer the phone once. So we would call and it would go to voicemail and it'd say, leave a voicemail and they'll call you back, right? That's not how you manage these facilities. If the phone rings, you have to be the first to answer because they'll move on to the next one. Because if they know that they're going to be in an area, you need to be the one answering. When we did our due diligence, which we do on every deal that we do. So in the due diligence process, we went and walked every unit and we looked at every unit and we opened every door that we could find. So all of the doors that we could find, we found, I think, 32 that had stuff in them that had no rental agreements. That's a big deal, right? So there was a community understanding that you could just go and use the facility for free. As we started to uncover some expenses, especially in the utilities, we found that in some of the units they were just losing money. So we felt like that this was undermanaged to a degree where bringing a professional management process will go ahead and bring that out. Will go ahead and allow us to overall raise the net operating income. So I hope that answers the question. And if it's a follow-up question, go ahead and type that in. The thing over here that I'm talking about as far as another key factor with self-storage in general is the fact that you have a diversified group of people. You aren't dependent on any one customer. You're managing occupancy to units and unit sizes. And the three main categories that Nikki talked about as far as customers, we would market directly to each of those types of customers differently. So we've got the ability to manage against those items.
So this is just a short list of the selection criteria that we look at initially when we evaluate a location that we are either looking to buy existing or to do a ground up build. And some of those things that we look at right away is it's within the 3 to 5 mile radius or drive time. And there's a lot of data that exists within the 3 to 5 mile radius or drive time. With that, we look at population, we look at what's currently available in that radius or drive time. And within that as well, we go down to demographics, right? We look at if there's a lot of rentals versus home ownerships. And also we want to be in an area where it's an underserved market, right? We don't want the area to be saturated. And this criteria that we look at is all before we look at financial information. So this is top of the line before we really dig down into it. And the majority, a lot of the time, right away, we would disregard many facilities that are on the market today.
Some of the opportunities that we look for in a project is we want to make sure that we've got the ability to increase the pricing. Now, if we might consider a facility that's already at market or maybe even a little bit above market, as long as there's the ability to expand, like maybe we bring in portables and then we go ahead and rent up those portables, or we're able to grow that facility because the demand is there, right? I say that because growing net operating income is critical, and if we can do that by increasing rents, that's a single capacity. But if we have a really highly demand market that's not saturated with competitors, then we would consider buying that facility as long as we could expand it as well. I would say one of the easiest things that we get to do, it's easy for us, is to bring in a professional management process. We've managed our own facilities. We've worked with top tier operators and managers in the country, and we worked with some smaller management companies in the country. And we choose the type of third-party management company that we want to use based on the type of property that we have. If we're building a Class A facility that's 100,000 square feet, that's all climate control in a highly dense market with a lot of brand recognition for Cute Smart or Extra Space or Public Storage, then we might use a tier one operator who knows how to compete in that market. It's a different type of competition strategy. If we're in a smaller market, more rural, like these properties are, we might go with a smaller facility management company because they know how to be nimble and how to manage the nuances that come up with these types of areas. So the key factor is that we know how to A, manage them, and B, how to manage the facility management companies who are managing them. We know the KPIs, we know how to manage them, and we know how to work that out. Once we own the property, we know the types of tenants that we're looking for. We will do targeted marketing towards that type of tenant. Like if we don't have any businesses that are renting from us, and we should have carpenters and HVAC people and that kind of stuff, we would want to find out why. Why is there nobody there? And then we would want to target them and bring them in. Those are great long-term tenants who can handle price fluctuations and are going to rent because it's a great place to be. We get into the financial projections maybe 4 or 5 or 6 steps down the road. If the demographics make sense, if the density is right, if the traffic's right, if all of the underlying criteria is right, then we get into how much are we going to pay for it? How much can we increase the rents for? How much can we do these types of stuff? Is there deferred maintenance? What are the renovation costs? All of those things. But until then, we don't get into that. Good example is if we're looking in an area of the country that has a lot of challenges. Like right now, insurance is a major issue in the Gulf Coast and Florida. We don't even underwrite in those areas. We just said, hey, we're not going to invest in those areas right now. The volatility of insurance, the fact that insurance could literally go away, that's not helping us. That's not doing our job to de-risk the deal. Our job is to de-risk the opportunity and bring forth something that's more predictable than taking on that type of aspect. Are there deals there? Yes, there are. Are we missing out on them? Yes, we are. But that's a decision we've made because we're working with other people's money and we're using that, and our job is to de-risk the deal. I say this all the time. People don't give us money, cash. I mean, that's what this transacted. They give us their future. They give us the money they're going to need to take care of their parents, to send their kids to college, to retire on. Like that's something we take extremely seriously. And so when we talk about de-risking a deal, we talk about making it more predictable. So we can say, look, if all of the things go wrong, here's how it can predictably work. If all the things go right, here's how it can predictably work. And we try and get rid of the things that we don't really have a ton of control over. The key aspect in commercial real estate is net operating income. That's increase overall rents, decrease overall expenses, and that's net operating income, right? How do you increase that over time? That's a critical component. Then some of the other things that we look at are cap rates and net present value and internal rates of return and debt to value, debt to loan, or debt to cost kind of numbers and those types of things. They all come into play as well, plus a whole myriad of other things that we look at to make sure that the deal makes sense to us, it's predictable to us, and we can then go ahead and raise money for it. As far as exit strategies go, it really is just two aspects. A, we're going to sell it, or B, we're going to keep it. That's it. If we're keeping it, it's going to get refinanced. Best case scenario from my perspective is we, at the end of 4 or 5 years, we're able to refinance, get all of the investors their investment back, and get all of the investors their expected returns back. And we're able to keep the property as a team, right? All of us, investors included, and receive the cash flow benefits of that project into the future. That's the best case scenario from my perspective. If we're not able to do that type of stuff, we're going to have to sell that. Like, we have a responsibility to get the returns. Plus, I don't have a crystal ball that tells me what's going to happen in the future. So if we've got the opportunity to get the results, the returns that we said we were going to do, and it accomplishes the goals of the project and the facility, then we're going to go ahead and we'll sell it. If we had not sold the facility in 21 and 22, we sold 10 facilities in 2022, then we would have been hung out to dry with this increasing interest rates environment that nobody could predict that it would double, right? That wasn't a predictable kind of concept. So our job is to be clear about what the goals are, to put the investor groups first, to make sure they get the returns that we're targeting to attempt to get, and then from there we can grow. We don't believe in getting greedy. Let's get it done, and then let's go ahead and move on to the next project. So hey, John, I see that there's a question, which is, what is the biggest risk in this investment from like a limited partner, in my opinion? And then what is the biggest risk to not hitting the targeted IRRs in your assumptions? Okay, so I mean, IRRs are all time based, right? So if you get the numbers that you want in 4 years, the IRR goes up. If you get the numbers that you were expecting in 6 years, the IRR goes down, right? So it's a time-based kind of component. In this deal, there is a cash flow mechanism that gets paid out at 6% annually, plus a split of the profitability above the 6% return. So it gets paid out on a quarterly basis, but it's an annual number. So obviously, if the NOI doesn't work, right? If for some reason we're not able to hit our estimated revenue numbers, if we're not able to hit the estimated expense numbers, right? Let's say like 1 year in Minnesota, the project we had, it was a horrible, horrible, horrible winter. And we had estimated, I think, snow plowing at $4,000 or $6,000, and it was 20, something like that. It was just a massive, massive dump. So that 1 year, we had more expenses on that line item than anticipated. You know, those are things I can't really control. But the things we can control, we do control. So I think that the NOI is the biggest deal. The speed to which we get to NOI, right? So if we get to the NOI that we were expecting to at the end of year 1 and end of year 2 and end of year 3, then we're just on track. And that would be something that would not happen. If 5 years down the road, the only interest rates we could get were 12%, right? That would be it. We have to get a 12% loan. Fortunately, this deal could handle a 12% loan, right? And you could look at that. We'll look at that later on in the financials. It could handle a 12% loan. That would suck, right? We wouldn't want to do that, but it could handle it, right? So I think that these variables are the same types of variables that you have in any alternative asset class that is dependent upon selling or refinancing at a specific date time in the future. I will say that it's never taken us 5 years to get to that point. So that's good, right? That's a good thing. I would also say, though, that the cycle in which we were able to sell all 10 of our facilities was at the top or the peak of a cycle, and we're now kind of in a trough portion of what I would consider in our cycle right now. So I feel very confident in the ability to hit that. You asked, what is the biggest risk in this investment from an LP position? So this limited partners kind of concept means that there's limited interaction, right? So the person they're going to have a limited exposure. They're not going to be actively managing. They're not going to be actively involved in the day-to-day. They're also limited to the amount of money they can lose. The most that they can lose is the money that they are invested, right? So that's the maximum. It's kind of like investing in a stock, right? You can the most you can lose in a stock is what you have. You take on no financial responsibility. us, the management group, we take on all the responsibility. We can lose all of it. Like we're personally guaranteeing a lot of this stuff. Like we could lose everything, right? Our homes and other things like that. So I think for the ease of mind for the investors is that we have the potential of losing a lot, right, in these structures. I will say the mitigating factors come into play. Before this deal were to lose money, we would sell our portion, right, the manager's portion, and raise more money, not diluting the investors, but diluting ourselves, and then making the project go well and getting that taken care of. If we got to the end of the day and we were only able to sell this for what we have into it, then the investors get all their money before we get anything, right? So there's mechanisms in play that protect the downside losses for the investor. I would say a catastrophic event could be like a Flint, Michigan kind of concept where all of the water was lead-based or something, and these communities that here in Iowa we all have a pretty good idea about them. If there was some catastrophic events that happen in these communities, that's a downside possibility, which is the same downside with any other commercial asset class. The risk of the investment to the limited partner. You got to trust us, right? Like if you don't trust us, then don't invest with us. Like that's the key component. Like you gotta, like that's important, right? You've got to know that we want to stay out of jail. This is a heavily regulated offering. It's an SEC regulated, 506C regulated. We've notified the Securities and Exchange Commissions. This is what we're doing in every state that we have investors investing from. Then we let the state SEC divisions know as well. Like it's a very regulated concept. We have a lot of attorneys who keep us in guidelines. There are groups out there maybe who don't do everything the way they need to. The firm that we use here, local at Wellgard, is our CPA firm. They do our taxes on a lot of our personal projects and that type of stuff, but also on this project. They're a very well recognized and local company that we work well with. So I think from a financial perspective, we've got all of our legal and stuff covered. And then from an operational standpoint, we've done a lot of deals that allow us to understand the flexibility and the flow. So to recap, the potential downside for a limited partner type of investor is if we don't hit our numbers in the timeframes that we say that we're going to hit them, and we don't get it sold or refinanced at the rates and the times that we've got it. That would be the things that would negatively impact IRR. As we go, obviously, moving forward, if we go more quickly, then we would increase the IRR. One thing we weren't planning.
There's another thing that I would want to also mention that we always talk about when we're looking at acquiring a facility or building is also if someone is developing or building another facility right close to there that's going to be a direct competition to us. It's always important for us to know and understand our competition and to know where we stand in the market of that area, right? We always need to have that awareness the whole time because we need to be able to mitigate against that, right? And understand that criteria.
It's funny you mentioned that, Nikki. I didn't bring it up. That's good that you did. We want to be the company out there building the 80,000 square foot brand new facility and dominating the market. Like we want to be that company, and we do that in other areas, right? So we know what that is. With the exception of Ames and maybe Huxley, but with the exception of that nobody's going to go build an 80,000 square foot climate control building in competition with these areas. They're just not the right market to do it. So
Right.
that's that. John, why don't you go ahead and take over?
Yeah, you bet. And so to give a summary of the deal that we're talking about is it's 13 facilities right here in central Iowa. We got into a purchase agreement later on last year, and we actually closed on 9 of those 13 facilities in early November and extended the closing of the remaining 4 to the end of this month, end of January. We're proposing an internal rate of return of 17.6%. And part of that 17.6% is we do pay a 6% preferred rate, not in addition to the 17.6, but as part of that 17.6 on a quarterly basis to the limited partners. And then anything over and above that 6% that we have in income for that quarter, we split between the general partners and unlimited partnership. And so there are going to be some months as we get on down the road and our NOI goes up, you should be getting more than 6% on a quarterly basis. And so, and what's nice about this is even though we only closed on the 9 so far, we ended up, our management team is managing all 13 facilities. So now that we have been able to take control of that and manage them, we got a really good idea of what we actually have, and we're getting the ball rolling. I think we're up a net 20 or 21 units so far as net clients, and everything's moving in an upward fashion. And so, and we're doing that just by superior management. We're getting into the local marketing, digital advertising, engaging with the customers, answering the phone on a timely basis. Increasing the occupancy and then optimizing the rental income. We found several units that were probably below market rent and starting to move those up proportionately right away. And so the deal is we're doing a total equity investment from limited partners of $3.22 million. We've raised a huge portion of that. One of the deals that we did to make this work is we were able to negotiate seller financing for $8.8 million of that purchase, and we secured it at 6%. And one of the things that made it work real well as far as our NOI goes is we got interest only for the first 2 years, which keeps our income up so we can help those limited partners get a quarterly return easier than if we were paying principal right off the bat. And so with that being said, we aim to double everybody's money, about a 2.1 multiplier at the end of the 5-year deal through either a sale or a refinance. And like I talked about with that IRR of a 17.6%. And so one thing I want you to notice is all the background photos that we have of the presentation, those are not boilerplate photos of self-storage. Those are actual photos of the actual units that we have already acquired and some of them that we're still yet to acquire. And so we've closed on the 7 in Boone and the 1 in Granger and the 1 in Madrid, and we're managing the 1 in Ames and the 3 in Huxley that we are yet to close on. Totally, that ends up with 1,238 doors or rental units, 62 parking spaces, a little under 200,000 square foot of net rentable space, and a gross potential rent income of a little over $1.4 million. And so where that breaks down to is we have the senior loan, which would be the seller financing. So the seller is holding back $8.8 million, 6% interest only for the first 2 years. And then we are raising the $3.22 million from limited partners. And how that breaks down is the purchase price was $11 million. So $2.2 million of that was on the purchase price side. And then we've got $400,000 in CapEx. Capital X stands for capital expenditures, and that is to replace bad doors that were bad. We are upgrading the whole camera system so our management company can basically get eyes on every single front door of all the rental units at any one time. just a superior way to manage it. We're upgrading the gates, the internet for the gates, so they can control those gates remotely. $50,000 worth of working capital is just, cash that we need in the bank to do every, day-to-day business and things like that. And then the fees consist of management fees, acquisition fees, and things like that.
This slide is exclusively the revenue side of the operations. We'll get into expenses after this, but this is something that maybe people who aren't familiar with self-storage want to just take a little bit of time to sort of look at this. We assumed that, well, let's just talk about the left-hand side. Admin fees, that's a fee we charge when people rent from us. And if you've got a high velocity of turnover, I mean, there's a lot of people buying houses, selling houses, they're doing short-term rentals, then we get a larger admin fee. If people are staying for longer, then we're typically going to have a higher rent fee that goes over time. Turns out that late fees, that's a big deal in this industry. I remember the first couple of years, 1 year we had $86,000 in late fees. That's about $1 million in valuation. It's a big number, right? The late fees is an important number to manage. A lot of companies don't really manage to them. A lot of companies have this emotional attachment to, I don't want to charge my friends late fees kind of stuff. We recognize it as a revenue generating aspect, and it is an important part of the overall revenue stream. Tenant insurance. This is like renter's insurance for renters who rent a multifamily or something like that. The tenant has to buy or provide coverage for the items inside the facility. If they own a home, a lot of times or sometimes the homeowner's insurance will cover that. Sometimes it won't. We offer it. It's either a protection plan or an insurance plan, depending on the state, depending on regulations, that kind of stuff. And Nikki, I think we're doing protection plan. Is that right?
Yes.
Yeah. Okay. And then the other aspect is that they can buy it from somebody else. Like they don't have to buy it from us. Right? They can really get it from wherever. It is a revenue stream that comes into us. And when you look at like Extra Space and some of these bigger players, they have a high absorption function to this. Like 95% of all the tenants buy their insurance from Extra Space, those types of things. Like there's a process of making sure that you've got the system set up, that it's working well. The revenue for year one, we did not change at all. We assumed in the model that we would do the same amount of revenue that the previous owner did for the previous year. We didn't assume any changes to the revenue from the net rental number, simply because that's a conservative approach. Like what happens whenever there's turnover, there's some flexibility. You find some things out, right? But we know that we're bumping rents here in February because people don't like to move when it's -5 degrees outside. Like we know there's times of the year to go ahead and push rents, and then that's going to allow people to get used to that new rent rate. We didn't build that into the first year of revenue numbers. So the effective gross income, or EGI, is down at the bottom, and that's what we're expecting to do and hit across that. I would anticipate across the 13 units that we would do better in the first year for sure. And as we do better in the first year, that then progressively increases all of the years behind that. This is a revenue, this is an expense slide. As before I mentioned, the four main expenses in self-storage are labor, property taxes, property insurance, and then utilities if there's a large component of climate control or temperature control units. This is an important thing to understand. Our attorneys told us that the property tax range could be from this 143 and as low as 95,000. We put 143 in here, and I anticipate it'll be the 93 because of the way we bought it. We bought it part of it as buildings and part of it is goodwill, and goodwill doesn't get in the state of Iowa. It doesn't get wrapped up into the sale price, and so Iowa is a disclosure state. You disclose what the purchase price was, and the purchase price that we have on all of these units is $7.5 million for the building and the land, $3.5 million for goodwill, because it comes with a name, it comes with other things of value. So I anticipate that the expenses will be $93,000, $95,000. That's $50,000 savings per year over 5 years. That's $250,000 extra that we could have in cash flow to cover for other maintenance items or for distribution, effectively. So we build in these types of conservative approach so that if the deal goes just like we think it's going to go, or if it goes not as good as we think it's going to go, we're going to hit these numbers and then we'll be okay. But if it goes like we think it's going to go, it'll be better than these numbers. We've already noticed some utility issues. The previous owner was renting out some stuff and was effectively losing money on some of the rents because he wasn't getting compensated for the utility expenses. We found some of the tenants that had deep freezers in their units, and that's a massive draw on electricity. So if those tenants want to keep doing that, then they've got to pay the utilities. So we know how to manage against those things. I will tell you that when the sponsor, when the manager, when the owner takes their eye off of actively managing against expenses, they can easily creep up, and all of a sudden you're losing $3,000 or $4,000 or $5,000 a month across the portfolio, and you didn't even notice it. So that's our job, is to try and manage against that on a month-to-month basis. We've got $400,000 in capital expenditures, but we maintained the $70,000 repairs and maintenance. That's a lot of repairs and maintenance, right? So we would anticipate that repairs and maintenance to go down simply because we're doing capital expenditures to stop the need for those repairs and maintenance. But that's what the previous owner had been doing historically. So we just kept that in there. I would expect property taxes and repairs and maintenance to come down. Labor, there is a facility manager who's working on site, right? Obviously there's 13 different sites, so that facility manager doesn't sit at all those locations. That employee is not our employee, and this is a big deal. That employee is an employee of the third-party management company. We don't have any risk of employee liability. We don't have any unemployment insurance issues and those types of things, workers' compensation claims, and those types of things. That all sits with the third-party management company. The off-site management are the fees that we pay the third-party management company. That includes their call centers. That includes all of the people to do the things that they need to do, and that. So if you look down at NOI, you'll see that increases over time. And then in the red, this is the debt service. The first 2 years is interest only. The 3 years after that is amortized at 23 years. So you'll see year 1 and 2 is the same number, and years 3, 4, and 5 is a higher number. The cash flow, or the cash flow after debt service, right? You'll see in year 3, it drops from year 2 because that's when we start paying back principal and interest. So the cash flow drops a little bit. I believe, and correct me if I'm wrong, Nikki, I think it's $193,000 or $197,000 is the 6% preferred rate of return. So that's the amount of money that gets distributed to the investors before we get anything, right? Like that's not our, we don't get any of the cash flow from operations from that. So a majority or the bulk of the cash flow from operations goes directly to the limited partner type investors. And then there's a split after that gets separated out. We're incentivized to push profitability, to make sure that all of the things that need to happen correctly in order to get paid from operation. Like that's an important function. Philosophically, I believe that's important. I believe it's important for the sponsor, the operator, to get paid with the growth of the project. That's just the way I philosophically see things. This is a graphical component to the numbers we just looked at. See, the project's going to make about 4.7 million. Investors are going to make 2.8 million. There's if we look down here in the very lower right hand corner, says 11.27. So that very lower bottom says total LP returns. That's 11.27. So that means that in year 5 from operations, we'll be getting 11.27. Now you remember the question earlier was like, what happens if, like, what's the risk? Well, the risk is if we had to take a 12% loan, right, then that would diminish this cash flow significantly. We could still handle it, right? The project would manage it and handle against it. We just wouldn't like it, right? It wouldn't be great. So this accelerate or this higher cash flow in the later portion or later part of the project is an important factor there. This is a standard disclaimer that every deal out there should have. Past performance is no indication of future performance, like historical, that kind of stuff. We're not CPAs. We're not attorneys. We're not registered stockbrokers. You need to work with your trusted financial advisors, the people who understand alternative investment strategies and alternative asset classes. I think it's important for you to not only invest in one or the other. I think that there is some value in diversification when you're not physically actively managing certain things. I think it's really important to understand that this is an SEC regulated project, and that we are very careful in making sure that everything is flowing accordingly. This disclaimer, you read it, it's a standard disclaimer, I think. If you find yourself saying, hey, I'm interested, in either investing in the deal or investing with the fund or just understanding us more, like, you can reach out to us at investor@momentumwealth.fund. One thing we didn't talk about is that our fund is different than other funds. This is a customizable fund. In a lot of projects, you have what's called an open-ended fund or an evergreen fund, or it's an equity fund or whatever, right? And you invest in the fund and they invest in multiple deals. Even though we've got multiple deals, every investor gets to choose which deal they want to be in. We have some investors who don't want to invest in certain states. We have some investors who only want to invest in certain states, right? And so they may say, listen, I don't want to invest in Iowa because I don't know Iowa, but I do want to invest in Texas because I know Texas, right? That's what it is. So that's the customizability of the fund. If you want to achieve this type of returns, we've got the history. We've done this. We've experienced the ups and downs. We learned in our very first project how important due diligence was, and we overcame some of the newer growing pains that we had during that time. We don't have those anymore. We aren't making rookie mistakes. We understand what the end should look like, and we buy accordingly with the end in mind. You can check out our website at momentumwealth.fund, or you can reach out to us directly. I'm looking over here at the questions. I think we've answered all of the questions through the presentation. John or Nikki, is there anything you'd like to say prior to closing out for the night?
No, I don't have anything other than just I encourage anyone that's still on there to go ahead and type in any questions you have. We definitely want to make sure that we answer your questions fully, and so you go away feeling like you understand the project in its entirety.
All right. Well, and as a reminder, after this gets finished, it'll convert, and then we'll send the link out to everybody so you can watch it again. This was longer than expected. Typically, we try to keep them much shorter, but we wanted to give everybody the information they needed. So have a great evening, and we'll talk to you guys all later. Bye-bye.
All right, take care.